we've got Harsha Upadhyaya as well, who's joining in. He's CIO Equity at Kotak AMC to give us his view on the markets as well as his outlook on sectoral preferences. Thank you so much for taking time out and joining in. So much to discuss. Let's just first up understand how you're looking into the momentum that we've seen in the markets. The fact that the macros really seem to be supporting what we've seen at an index level. Do you believe that there's more steam left in the markets?
Good morning. Clearly, most market participants expected markets to remain quite range-bound, at least during this earnings season. So to that extent, the kind of resilience that the market has shown and the breadth that we have seen over the past few weeks is definitely encouraging. I don't know whether it has steam to make a new high at this point of time, but clearly I think undertone remains quite okay. Overall, we are looking at an earnings season where it will be a marginal improvement as against the December quarter. Even as you look at first half of this earnings season, until now we have seen about a 20% year-on-year growth in terms of earnings. Obviously, this has been led by some of the frontliners. We'll have to wait and see how the broader market responds in terms of earnings in the second half. But broadly, I think we should be able to get a earnings growth, which is more or less near the market expectations.
All right, fair enough. Now you're looking at revival-linked themes in the markets at the current juncture. So Harsha, in light of that, what is it that would be on top of mind when it comes to looking at sectors at the current juncture?
Clearly, we have been positive on many domestic-oriented businesses. Clearly, domestic growth remains more resilient than global growth. Banking remains one of the top sectors across our portfolios. We have seen credit growth improving, asset quality issues have kind of subsided quite a bit. Overall situation for the banking system growth seems quite conducive, and we remain positive on this. In fact, this is one of the sectors which will have significantly higher earnings growth over the next 2 years as compared to the market. We are also positive on a few other domestic businesses such as industrials, auto, cement, etc. All of these pockets, we believe that there is significant growth ahead. And if we make the portfolio cautiously looking at the valuations within the sector, then I think there is definitely upside that can be captured.
Harsha, hi, this is Anish also joining into the conversation. Wanted to get a sense from you with respect to the auto stocks. The April sales data doesn't look very enthusing. Do you think the rally is likely to derail there?
To an extent, yes, the volume growth scenario hasn't panned out the way market was anticipating. But nevertheless, we believe that the supply side constraints, at least for the passenger vehicles, should improve over a period of time. And also we are expecting gross margins to improve as commodity prices have really cooled off. So I think the benefit of these two things should start to come out in terms of results, maybe in the June quarter or in the September quarter. So that's when probably we'll see a bigger kind of a rally in the auto stocks. Nevertheless, I think at these valuations, these are reasonably priced, I would say.
What are you doing with respect to your weightage for the IT sector? Are you looking at reducing it, or selling out some of the stake there as far as IT pack is concerned?
It's been more or less a status quo for us. In fact, we went negative on IT sector sometime around last quarter of 2021. And since then, we have been maintaining an underweight stance. And clearly, this has been driven by a lower than expected global growth and also the kind of concerns that are coming in few verticals such as BFSI, telecom, etc. While there is still a debate whether some of the weakness that we saw is related to specific companies or to the overall sector, etc. But clearly, over the next couple of quarters, we believe that business momentum is unlikely to revive in a big way. To that extent, we remain cautious. And as I mentioned earlier, we believe some of the domestic sectors have better legs in terms of seeing better demand conditions, and also profitability margins should improve for most of these domestic oriented businesses. And hence our positive view on domestic businesses continue, whereas the underweight stance on IT still holds.
I just wanted to understand your outlook as well on the whole as to, whether or not you see us falling prey to the concerns that we have overseas with respect to the kind of slowdown that we're seeing. Do you think that, that theme, that word rather that we used quite popularly a few months ago, that we're seeing a decoupling when it comes to the Indian markets, actually holds true, or we are likely to pretty much trend basis what we see across the globe, or the fact that our fundamentals back home are looking rather promising, that we could chart our own course?
Well, I would say the economic growth continues to be much more resilient than what we are seeing across the globe. Even inflation trends have been much more moderate in our country, and we, anyways, have a positive real rate at this point of time. So, to that extent, I think the monetary action in India will be a lot more calibrated as compared to what you are likely to see overseas. While this is true, I am not so sure whether one can say that we have completely decoupled in terms of the sentiments. I would guess that sentiments would still be driven by what's happening across the globe. Every now and then, we may also see the kind of knee-jerk reactions that are coming because of what's happening in US or in Europe in terms of economic data, etc. However, I think once the dust settles, I think our markets will have more legs to really go higher as compared to some of the other markets. And also, one of the other issues that we had to contend earlier was our relative expensiveness as compared to emerging markets or some of the other competing nations in terms of flows. For the last 4 or 5 months, clearly that expensiveness has got corrected quite a bit. And while we continue to remain expensive compared to some of the emerging markets, this expensiveness is more or less similar to what we have seen in the past as well. So to that extent, I would say our relative premium continues to be more or less in the zone that we have seen in the past. And that should enable more investors to look at India from a longer term perspective.
Okay, let's see whether those investors, foreign investors, look at India positively or not. But Harsha, wanted your sense with respect to how the market setup is, large cap versus mid cap. Of late, we have seen quite a bit of rally, at least in the month gone by, in the mid cap names. Do you think that's likely to be the case for the rest of the year as well? Or given the volatility we are talking about, it's better to stay with the large cap quality names?
We remain slightly cautious on the mid and small cap basket at this point of time. Clearly, the macro concerns are going to be a larger headwinds for this basket as compared to that for large caps. And also in terms of valuations, mid and small caps, despite the kind of sideways movement that we have seen over the last couple of quarters, their valuations seem to be slightly higher than that of large caps, while large caps have clearly been in the fair zone of valuation from a longer term perspective. One cannot say the same for mid caps and small caps at this point of time. And also the earnings volatility, as you rightly mentioned, could be higher for mid and small caps. So to that extent, while we are neutral on overall equity allocation, we would suggest a slight tilt towards large caps at this point of time. And maybe over the next couple of quarters, if there is more of time correction or value correction, or if there is better visibility in terms of earnings, then probably would be the time to look at increasing allocation to mid and small caps.
I don't see any pharma, stock or big presence as far as your top holdings are concerned in some of your portfolio. How are you positioning yourself with respect to the pharma sector?
On the pharma sector, we have been quite selective. There is no single driver that's driving the entire sector either positively or negatively. So to that extent, we have been evaluating companies on a bottom-up basis. And if you look at the overall cumulative weight of pharma within our portfolios across the board, yes, definitely it's an underweight. So to that extent, at this point of time, we don't see any big driver from pharma, apart from the fact that it has underperformed over the last 4 or 5 years consistently. There is no other single driver for the sector to really look at.
All right, what's the outlook on the Capex theme? Because that really seems to be a story that a lot of market experts are building on. I assume you'd be positive on this space, but Harsha, give us a view as to how exactly you believe investors should play it, given that we've already seen that furious run-up play out across sectors like, say, railways or defense, and even capital goods like L&T to a certain extent.
Well, clearly we have been very, very positive on the entire capital goods industrial segment. And we have seen overall investments into capital goods or engineering related companies going up significantly over the last few years, despite concerns like COVID, etc. There is also an export opportunity that's unfolding. So overall, the entire space seems to be seeing quite a bit of traction. If you look at the overall investments of private sector as well as central and state governments over the last 6 years or so, despite some of the hiccups like COVID, we have seen this number almost doubling over the last 6 years, and there is no reason for us to believe that over the next 5 or 6 years this cannot move even higher. So to that extent, I think the runway for growth for industrial seem to be very, very strong. We have seen overall average capacity utilization going up towards 80%. And once it crosses 80%, we will also hear more of capital expenditures from most of the other manufacturing sectors as well. So to that extent, I think the overall space continues to be one where there is significant runway for growth. Yes, some of the valuations have discounted some of this growth. So that's where one needs to be looking at opportunities within the sector based on valuations, not just growth. And overall, I would say this space can still provide a lot of outperformance over the next couple of years.
Right. Okay, Harsha, we'll let you go on that note. So long runway of growth is available for industrials. Let's see where they head from here on. Appreciate you joining us on the show now.
Thank you.